Michelle, and I'm on the community team here. For those of you that don't know, here at the assemblage, we are a co-living, co-working, social and event space. We offer a range of daily programming, including yoga, tai chi, breathwork, meditation. Overall, we're a health and wellness space focused on going higher individually and collectively. We believe in being of service. We have an amazing elixir bar right here on the floor, and upstairs we have a plant-based cafe, so please do check those out for delicious drinks and nourishing food. To your right are bathrooms. If you're interested in learning more about membership and being a part of our community, please seek out anyone with these pom-poms. And we're here live tonight. Discussing the future of funding with SheWorx CEO and co-founder Lisa Wang and investor Arthur Bavelas. Discussing unlocking family office money and funding techniques for startup founders. Thank you so much for joining us, and without further ado.
Thank you. Good evening, everyone. My name is Lisa Wang, and I'm the founder and CEO of SheWorx, which is a global platform that has empowered over 20,000 female entrepreneurs to gain access to the right networks, mentorship, and skills. And I created the Future of Funding series through my work because it became clear that the current funding landscape is so unevenly distributed. And one of the biggest problems is just simply lack of access. So in 2018, only 2.2% of venture funding went to companies with a female CEO, and that number goes down to 0.2% for women of color. And on average, women start with 6 times less capital than men. And so why does disparity continue to exist when capital is abundant? So the Future of Funding is a series where we're going to discuss what the future of capital distribution is going to look like with innovative investors like Arthur, who are disrupting the status quo and giving you actionable ways to access this funding. So tonight, we will be discussing one of the most opaque sources of funding, and that is family offices. In the last decade, there has been a 10-fold increase in the number of family offices globally, and it's reached approximately 10,000 single-family offices. And what's more impressive is the sheer amount of wealth that is being managed by these firms, which latest estimates say is around $4 trillion. So before we get started, just a quick show of hands. How many people here are entrepreneurs who are currently fundraising? Great. And do we have any investors? Awesome.
Can I ask one more question?
Of course.
Does anybody know what a family office is? All right. We got some work to do.
And so everyone here is going to be in for a treat, and we are also joined by our Facebook Live audience tonight, who will be part of our digital audience. And for the second half of discussion, after we go through some questions, you'll have a chance to answer questions, ask questions, and ask Arthur directly. So, Arthur, today we are joined by Arthur Bavelas, who is the CEO of Bavelas Family Office Group and Family Office Insights, to discuss how he is leveling the playing field. He's an entrepreneur, an author, and family office investor. He's a pioneer in developing one of the first private opportunity peer review networks for investors within the family office community. He founded Family Office Insights to provide meaningful access and engagement for active, socially conscious entrepreneurs and wealth managers. And he draws upon his own experience building and exiting a successful tech startup to evaluate opportunities spanning tech, market access, and impact investing. Arthur, thank you for being with us tonight.
Thank you for having me. Wow. I wrote that.
You did. We have been friends for a while now, so I know you're impressive, but can you tell the audience a bit about your background and how it shapes your investment thesis today?
Yes, thank you, Lisa. And we have been friends for quite a long time. Lisa is a star if you haven't figured it out already. We'll find out more if you don't know it already. So the story is really short but instructive. I sold a company 22 years ago and didn't know what to do with the money. And it ended up being a meaningful amount of money 22 years ago. And so I did nothing for a while. And slowly I got to know others who had sold companies, and slowly I used them to help me evaluate what to invest in and what not to invest in. The most important thing I learned early on was I didn't know anything about most things. And so I was able to get others to help me when I said, here is a, let's just say, for example, a round D genome testing company, which is, I use as an arcane example for a reason. I would bring it to a friend of mine who had made all his money in that sort of business, and I'd say, what do you think about this? There was no way I could evaluate that on my own, but if I brought it to him or her, I don't mean to be sexist, let's just be clear, they would say, nope, not this one, next. So I was just trying not to lose my money as opposed to making money. And so what I can say it elegantly now, but I used others' domain expertise by proxy instead of building an analyst bench that would cost me $1 million a year in overhead. So the reason why I say the story's instructive is that's how I got to know what not to do. And it's more important as an investor to just run and run fast from things that don't make sense than, you know, just have money burning a hole in your pocket like my father used to say. So as time went on, I actually was able to deploy some capital in meaningful things that made meaningful money, and I obviously learned things along the way, but that grew into a community of others that slowly turned into family offices like I did, and so now it's sort of an official, even though there's some tone in my bio there about the dissatisfaction of being able to get deal flow, it actually was a mission to find interesting entrepreneurs doing interesting things that I could bring to my colleagues, and there's now 800 family offices in the community, so we look at deal flow very carefully every month.
Great.
So the only other thing that I would guess, I think what you were looking for is that community now is a robust deal flow community where we look at lots of things, and aside from the normal family office insights deal flow mechanism that we call it, we're in a very somewhat altruistic way, but a very selfish way, we're looking to democratize access to my peers, the 800 family offices or more across the world, because there are really smart entrepreneurs doing really smart things, and they just don't know how to get to the money, and it's very difficult.
So for everyone in the room, what exactly is a family office and what makes it a unique funding source?
So first, it's important to realize there's three different types of family offices. The one that we're speaking mostly of today is single family offices, then there's multifamily offices, and then there's commercial family offices. So there's some variations in all that, but for our purposes, a single family office is first, second, third, fourth generation, only their money, nobody else's. And so they're just trying to be mindfully with governance and not just with family governance, but governance with deploying capital in an organized, methodical way. A multifamily office is if you have a single family office and you don't want to do all the heavy lifting, you hire somebody and do it for you. And so a multifamily office has multiple families. And then a commercial family office is essentially, and I mean this in the most affectionate way, a bank who has a wealth management platform that has a family office silo that caters to the super, super wealthy. So for our purposes, we're talking about mostly single-family offices, simply because they have the pen. They can write a check if they need to, without going into the platform of a multifamily office or a bank.
And what makes it unique or different from venture capital or typical angel investors?
There's two things, and there's two primary things, and they can potentially be good or bad. One, someone can write a check and they can make a decision independent of a committee or some institutional investor without going through a process that often an institutional investor or a venture fund can do. On the other hand, there's no compelling reason to deploy capital in a hurry. So those are the two primary things. But what's really, really interesting about family office capital for the entrepreneur and somebody trying to grow or fund, even seed, angel seed, round A, B, C, is that family office capital is actually capital that comes along often, not all the time, but often with the desire to align your interests with the entrepreneur, as opposed to, and there's nothing wrong with having a job in an institution, but a person who has a job in an institution is making sure they get for their $500,000 a year and bringing their kids to school. Anything outside of that, they're not compelled to do anything extra. With a family office, they're writing a check and they're saying, okay, here's our money, and by the way, here's 13 of our friends that are also deploying capital that might be able to help you. And by the way, who do you need to meet? The head of Procter & Gamble, we know him or her. Oops, did it again. That is the primary difference. Family office capital generally, not always, comes along with all kinds of extra benefits because they're aligned to make sure you succeed. It's super hard to get to, but that's what we're going to talk about in a minute.
Great. So it seems like the network effects are really the biggest benefit if you do manage to unlock it.
Yeah, just think about the people that you know and the people that they know. It's a 6 degree of separation conversation, but it just so happens that people who are worth 500 million, a billion, second, third generation, they're not hanging out with people that only have $50,000 in the bank. Their peers are meaningful people in terms of that funding opportunities.
Can you speak about some common misconceptions when it comes to family offices?
In general, people don't know, which is why I asked what a family office is, but it seems like there's a fair amount of people who know here, and I hope I give you some idea what they are. There is a thinking that if you can talk to family offices about funding, it's easier to get than institutions for the reasons that I might have mentioned earlier, but it's equally hard to get because they don't have to deploy the capital. There's no big hurry. If you're an institution that is getting $300 million a week in and you have to put it out, then they have to put it out. A family office can just sit on it forever. So oftentimes people say, well, I'm not going to make it through the gauntlet of an institution, so I better go after family offices, and that might be easier. Not necessarily the case. It turns out that they're really smart, rich people, and they don't make cavalier decisions about anything. They dig really deep. So you have to be ready. So I think that's one common misconception. The other one is confusing multifamily offices with single-family offices with commercial family offices. It can get a little confusing.
Confusing because of all the extra stakeholders involved outside of single-family offices, or?
Just because they think if they're talking to a multifamily office, they hope they were talking to a single-family office. Like, it's just the language is difficult.
So how do you feel about the old adage of if you ask for money, you'll get advice, and if you ask for advice, you'll get money? How does that hold true for you?
Did you make that up?
Yeah, I just did.
I have to think about that. So one of the, I guess the best way I would answer that, Lisa, since we didn't rehearse that question, is one of the things that I learned from some really smart people is to ask questions always and ask the hard ones all the time. So I'm not answering your question, but maybe in some way, be prepared to have the answers to the hard questions, because if you haven't thought through them and they ask them, it's over. Like, you go back and come back in 6 months. So, but what you're really asking me is, why do you get advice when you ask for money? Yeah, I don't know the answer to that. Asking for money's hard. It's uncomfortable. But you have to have a compelling reason.
Well, I think one of the things you mentioned too is the power of questions, right? It's like the smartest people are the ones who are asking questions, not the ones who are shoving something in your face. So, to that end, one of the reasons why I think we get along so well is because we both have this keen understanding and curiosity about how irrational human behavior drives supposedly rational business decisions. So tell me about what drives you to invest and transfer that money into someone's bank.
So I'll answer that, but first I'll use an example of irrational behavior. So I know you guys are in this really cool, hip place here, and which I happen to like and very much, and have been to the assemblage uptown and so forth, and we know Rodrigo, the founder, and all that business. So I'm going to make a hipster question, right? So does anybody know what FOMO is? Okay, so, right, we know what FOMO is. Why do you think that when the big VC firms in Silicon Valley say, we're putting this money into this opportunity, that everybody falls in right behind them?
Because they're sheep.
Right? So they, what is it?
Because they're sheep.
Lemmings? Do you know lemmings really don't go off the hill and follow? Did you know that? It's true. Everybody uses that example. Lemmings follow them. They don't do that. So sheep, that's another thing. So the problem is that people are looking for an excuse not to do the work, who have money that just, and people generally aren't cavalier or not thoughtful with their money, but if somebody of note that has some experience is a lead investor in something, that gives you some level of confidence, right? And so that's what's happened, and one would argue that that's just one data point, and if you're not doing the rest of the work, that's super irrational behavior. And so, on the other hand, I just said to you, if you're a family office anchor investor, they're going to socialize it with their friends, and they could follow on with that family office. So I think the point is that you still have to do the work. And so as it relates to my irrational behavior, I tend to not invest in things that I don't control, and I miss out. So I irrationally want to feel like I'm in control of something, and so I can't be a passive investor often, although I have been, but not recently. And so my irrational fear of not being in control causes me to lose out as a minority investor in Uber, in Groupon, which I didn't have the opportunity of, but somebody here did. So that is my irrational behavior from time to time.
So when you say control, does that mean you need a controlling interest of 51% to be able to invest in a company?
Yeah, but that's idiosyncratically me today, but it wasn't me for the last 15 years. It just so happens to be. So I consider it irrational and recognize it, but which causes people to not get into the checkbook, but it satiates my irrational desire to be in control.
Would there be any type of opportunity in which that might not be the case today?
Yes. I haven't seen it yet, but yes.
What kind of factors do you think would drive that?
Downside protection. So imagine if you had an opportunity to invest in something, and that it was an operating company that proved a business model, and it was clear that it was scalable, and that you could deploy a non-controlling interest into that company for a non-controlling share, and that if all the wheels fell off, you'd still get your money back. That would be pretty cool, right? So that would downside mitigation risk. The other thing, we're probably going to get to it, but since we're talking about risk, is that there's a limited amount of appetite for the trillions of dollars that's in family offices that's sliced off to venture and startup and seed. But it's there. So you just have to figure out who has not exhausted their 0.02% of money that's in the family but that they didn't deploy this year, which is no easy task, but it's there. There's an allocation for almost every family to invest in venture. And so if you can help have them understand mitigating the risks, then that's one of the meaningful things you can do to help capture that capital. I think we're going to talk about that later, sorry.
To the point of downside risk, because I think that's actually really important to dig into, and how that's different compared to a venture investor who is optimizing for high risk, high reward. How is it different, and what are some of the psychologies that are driving the emphasis on downside risk?
So this is not going to be a welcome or fair comment, and it's a common refrain among the anti-venture groups, is that they're spraying and praying and allocating money that's mostly not theirs from investors and hoping that they get one or two unicorns and the rest of it's going to fail. So this is, the statistics bear this out, and hopefully they will change over time. The difference with not all, but some family offices that are directly investing in venture that have the ability to review deals in a meaningful way is that they'd rather just say no, 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 and instead of getting 100 venture investments and hoping that 2 are going to win. I can't tell you how many times I've talked to an entrepreneur, me being one of them, and I asked them, based on where you are and what you know about entrepreneurs and venture investing, what's your probability of failure? So if I were to ask you that question and you're an entrepreneur, you'd have a hard time admitting that it's 95% unless you were really solid and confident in your, but the statistics are what they are. But your ego doesn't allow you to say that it is. So when you're talking to somebody that knows that statistic and you say, no, 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 I'm not going to fail, that's cause for pushback. The other part of downside protection for family offices is that they just say no a lot, which is one of the reasons they're hard to get them to deploy capital. But if you make a really strong business case and do demonstrate that there is downside protection, not just against failure, but execution's everything, right? So if you're going to talk about what you're going to do with the capital, and you can demonstrate that you can well execute, that makes an investor feel better. Not just we have to pay salaries and staff and ramp up and send money to another country to build a MVP. I mean, that's just stuff's amorphous. There's no downside protection in all that. Wow, it sounds pretty harsh, huh? Sorry.
So to the point of confidence then, because I think especially in venture funding and venture pitching, everyone just keeps harping on how entrepreneurs need to be super confident, overinflate their numbers. How do you look at confidence and arrogance in pitching? And how do you respond when people are always coming to you saying they have the next big thing?
How do you respond? Like if someone says to you, no, 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 we're the best. what does that mean? Everybody's the best. I'm the best. Are you the best? Or are you ever going to say you're not the best? So the language is really important, and arrogance can be spotted a mile away, and arrogance is much different than confidence. Confidence is when you get asked a question about a really important a deal point or whatever's happening with your company, and you confidently answer that question because you know it cold, that's much different than arrogance. Arrogance is, look, if you're lucky, you can invest with me, and if you miss this opportunity and I walk out the door, then you're done. I mean, I don't know who's here from Silicon Valley, but I mean, this was happening a lot there. So confidence is much different than arrogance. And of course, you know, the way I react to that is the door is right there. Why are you making me a bad guy?
Have you seen any differences between how women and men pitch you?
Yeah. Actually, I think you were there when I talked about this. There's been an unfairness in almost every way, not just in business for women executives, women entrepreneurs, and I hope that the pendulum swings this way and it becomes unfair to men and then comes back to the mean and settles somewhere, just because I've seen some pretty harsh stuff. I will tell you that the preponderance of what I see fleshed out by the statistics is from men. So I don't see a lot of women. And I would say the difference is that they feel they need to do better and pitch better and be smarter, just because they come into the room with, some of them, not all of them, with a feeling that they're inadequate in some way as it relates to the eyes in the room if they're men. And I'm not trying to suck up to the women in the room or anybody else for that matter, but the women that I see in these positions and pitching are much smarter than the men, and they handle themselves well, but there's clearly an edge where they feel they need to be just a little bit better and a little bit smarter, and they've got all the details covered. So I'm just telling you the facts. I don't know if that's good or bad, but that's the way I've seen it.
So it's the feeling of never being good enough in some ways.
Look, it's not all of them are that way, but it's clear. And I have two daughters that are 33 and 32, and they're super smart and bright. And I say to them, you know, I never look at women in a way that there's a woman across the desk doing business with me or a man. I don't see the distinction, except when the distinction is brought by them. And it's I think I've got a clear lens, but who knows what's happening in my head. But there's definitely an edge that I see that is often apparent, that they're just trying to do better.
And
Did I get everybody upset? Because this is the truth. I'm not telling you, right?
And in which part? Because I
Yeah.
think the numbers are obviously very important because it shows that you've thought through the process and the plan of how you're going to execute, which, to your point of downside risk, shows that they know what they're going to do. How does one talk about the numbers to someone like you, especially if it is early stage?
The math's always important. So when someone hasn't thought through this, either the scalability or, so there's Nassim Taleb wrote a book called Anti-Fragility. And Anti-Fragility, all it really means is you better build in some wiggle room. And so if you're not thinking of, if you haven't calculated the numbers and made enough accommodation for all kinds of things to go wrong, then that is a red flag. Because what's the number one thing you can count on? Or two things, death and taxes, and something going wrong, right? Something always goes wrong. You just can't predict. There's unknowables. So when it comes to the numbers, if there isn't any anti-fragility or some wiggle room built into them, then you know that the thinking is not good. And so it's a red flag right away. Was that your question?
So if someone were to come to you, would you rather that they caveat first with, we understand that this could go wrong and this could go wrong, this could go wrong, but here's what we're projecting for the next year to 5 years?
Yeah, so you stole one of my principles, right? Thank you. The number one mistake, I think, no, there could be more than this one being number one, but is, suppose I said to you and made a pitch, and I'm talking to you and I'm telling you all the good stuff that's going on, I'm painting this beautiful picture, and then at the end I said, but, and I'm not even going to make it up, something really bad is preventing this from happening, like the worst thing ever. Wouldn't you rather me said that at the beginning and have you walk out of the room and said no? So what people often do is they tell you, pitching, that, here's all the great stuff, and at the end tell you the bad stuff, all the risks and everything go wrong. The best thing to do, and it's counterintuitive, is say, look, here's all the stuff that can go wrong. I mean, you have to give some frame out about what you're doing. They have to understand the business that you're in. But the number one thing is to say, here's all the stuff that we're worried about going wrong. Boom, 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 right up front. It's totally counterintuitive to sales 101. But if you're telling me all that stuff at the end, and I sat through this and I could have said no at the beginning, I'm pissed. I'd rather you say to me, here's all the stuff can go wrong, and then I can decide whether I can live with the rest of it or not. It's a mistake that's number one that's done all the time. They hide the other stuff under the rug at the end in the hope. Of course, it's not their fault. They've been taught Sales 101. You bring out all the features and benefits up front, and you wait till the end. Bad idea.
Can you give me a specific example of a time when you found the business interesting, but then ultimately decided not to invest because of the leadership team?
I can't tell you the specific example because it would be disclosure that I'm not willing to make. But by all accounts, revenue, business model proven out, super smart, double PhDs, execution done well, and massively scalable business in the medical field, something that I could not so arcane that I couldn't understand. Scientists of mine reviewed the product process, all the background checks checked out, and the attitude of was actually a woman, just say, just to be clear. The attitude was so pervasive in that there was, she was smarter than anybody else, and it wasn't Theranos. Bad Blood. Did you guys read the book? Yeah. And there was just no way I could, first of all, I could live with me writing the check. What I couldn't live with is my friends coming in and writing the check with me, because they would have looked at me, and maybe this is a weakness, they would have said, you actually put money with that person with that attitude? So what caused me to pass was that I couldn't live with the embarrassment of my friends saying you did that. How about that?
Great. So let's say someone has moved past meeting one Now, tell me about the speed with which an entrepreneur can expect to move through the process and what that actual process might look like.
So let me just frame it out and make sure I understand. So you got a meeting with a family office. Let's hope you got 20, because one's not going to do it. They've actually asked for a second meeting because they like the business model. You have to disclose everything. Open up the kimono and show them everything. So the timing is idiosyncratically theirs. Some have allocated a certain amount of capital to startups and entrepreneurs in venture, and some have to go back and figure out to get an allocation from somebody else. I know this is not going to be very helpful, although maybe I can make it helpful. The pace at which money moves, no matter who the investor is never fast enough for you. So just a word of advice, have 20 family offices that you're talking to, not just one. And the process is no different than what you would think. First meeting, look you in the eye, business model makes sense. Second meeting, look under the covers a little bit more, get the analyst back in the home office to look at the data, do all the background checks in the third meeting, figure out how much the allocation is going to be, talk to the other investors who are investing in the company, if there are any, talk to the advisory board members and the lawyers and the accountants that are involved. I mean, this could easily take 2, 3, 4 months, depending on how fast things are moving. And so I guess you were looking for maybe more of a definitive timeline, but it's idiosyncratic to the family office, but expect it to take time. There's
Term
nothing
that you've used, which is the tyranny of time.
the tyranny of the clock, right? So once you meet somebody, no matter what the context is, to go from meeting them to liking them to having a real relationship with them in the context of this to actually writing a check, there's nothing you can do about that time. It is what it is. So my advice is to thwart the tyranny of the clock. This is what Lisa's heard me say before, thank you. Is that you start that clock ticking sooner than later, because there's nothing you can do to thwart that time. Aside, whatever that process is going to be, you can improve it, but there has to pass. There's nothing you can do about it. Unless you're an entrepreneur and you've had an exit and somebody invested with you and they got a 20x in 18 months, there's no way that check's going to be written again for the next enterprise in a short order. It just takes time. So start the clock ticking sooner than later. And don't be chicken, right? Sometimes it's difficult to pick up the phone and find people and call them. And there was a sales course I took early in my so-called career, which lasted about a month. And the sales trainer said, look, here's the deal. I want you to get a lot of no's. I go, what do you mean? He says, if you collect 27 no's, you're going to get a yes. So collect no's.
It's a very anti-fragile mindset.
Yes.
So get your questions ready, and this also goes to people on Facebook Live. If you want to ask a question, just comment. So if an entrepreneur now does secure funding, you mentioned briefly about the level of involvement that you might expect, but can you just talk us through how to engage someone like you? Is it through email updates, or how involved is really involved?
Yeah, it really depends on how much you own of the company, how big the check you wrote, what your expertise is in the area. But for me, I'm super involved. And I would say, for the most part, people want to not just write the check and wait for a quarterly report and wait for 3 years so you have an exit and hope that they get a 10x on their money. I'll repeat what I said earlier. People want to help, especially family office investors. I mean, they truly, truly have the ability to help, and they want to. And so in the case where I'm presently a non-control investor in dozens of things, I want them to just send me an email and say, we've been thinking about getting to this person. We don't know how to do this. What have you been doing about that? I mean, I do have 12,000 unread emails, but some of the ones that really matter bubble to the top. So for me, it's really simple. I want direct contact, and the doors are always open. And so I know few of my peers and my colleagues who would be they don't want just a K1 or a quarterly statement or be on the board and from time to time have the meeting. If something is needed, especially at the fragile stage of a startup, pick up the phone, send an email, text. I mean, I don't think there aren't very many of my peers and friends that I know that aren't going to be willing to just step up and help, because it's not about anything other than alignment of interests. Why wouldn't we help, right? There's only good that can come from that, not bad.
All right, so before we open up to Q&A, last question. Give me your take on the future of funding and how things will be fundamentally different in 10 years.
So one of the things that we didn't talk about is that there's going to be a variety of funding hybrids that come out of not just, so we have all kinds of interesting ways to get capital. But let's just talk about what we're talking about here: entrepreneurs, startups, seed, angel, A rounds. Imagine a time where you're taking the different pockets of capital now and crowdfunding, the digitization of assets, meaning ways of tokenizing things. By the way, I'm not one that thinks everything's got a blockchain solution to it or should be tokenized, but there's credible opportunities to fund things in that way. But imagine you're an entrepreneur, and I mean, the tax laws that we have now are just incredibly favorable to incubating and lubricating the process of starting businesses, because it's not even the wisdom of the government. It just made so much sense, right? So I'd like to give them credit, but I don't think they really understood it. I think it came as a consequence of some other things. But imagine you were able to get some friends and family, get the company started, have some governance in place, and then you said, okay, we're going to do a crowdfunding platform for the different levels of crowdfunding that are available. We're going to get money that way. We're going to get people who are ambassadors for our product, assuming we had a product to sell other than technology, let's say. And then we're going to raise money through a variety of venture family offices, and we can tokenize it and do a loyalty program, maybe not, by the token. And we can socialize, we can enlist ambassadors with social network to help us not only raise money but socialize the product that we're promoting. Imagine that. Well, we're living that right now, right? It's just taking all those household items and putting it together. So I just had a meeting earlier today with a group that's a master at the crowdfunding methodology, and there's no reason to take each piece of that and put it together into a whole way of funding things. And not funding without governance doesn't make any sense, because people get spooked. So you have governance, you have platform, you have crowdfunding, you have ambassadors, you have all the social media stuff. All this stuff is now at your fingertips. So in 10 years, I'm going to own all the insurance companies like Geico and Berkshire Hathaway, and I'm going to fund all the crowdfunding platforms with the assets from the insurance companies, and the reason why I bring that up is because Warren Buffett figured it out, is if he ever needs any money, he just lowers the rates on his Geico insurance, and when he doesn't need the money, he increases the rates. So I was being sarcastic. I'm not going to own everything. So in 10 years, I have no idea, but I think it's going to be a hybrid and a combination of all these tools that we have, and I think that they're going to. We were talking about democratization of access to family offices. I think that will look more like democratization and access to anybody that has a really great idea that can execute well and get the funding that they need. I think, that's not going to be 10 years, that's going to be 3 years. So.
And hopefully also the diversity of the types of investors, I think, is going to make a huge difference in who gets the investment.
I mean, even now you've got people who are not accredited investors writing $50 checks and helping entrepreneurs and being the best ambassador that they have. I mean, Kickstarter was the beginning of all of it. So I think that there's opportunity everywhere. So I'm super optimistic, by the way, if anybody didn't get that.
Awesome. That's something we share as well. So does anyone have a question that they would like to ask Arthur? Jerry?
So I'm a researcher, and I'm trying to better understand family offices. Years ago, family offices would have invested in private companies through venture capital. Now, like you, the direction is to invest directly. Are single offices more likely to do that, and maybe multi-generational or commercial less likely? Who's driving the direct investment?
So there's a reason people think that single family offices are more interested in direct investments, which is essentially investing without a fund platform, and the reason is to not pay 2 and 20 fees to the fund manager, and there is a lot of that happening now, a lot more than has happened in the past, simply because in the past people the family offices were getting sick of the 2 and 20 fees, but they didn't have the analyst bench, they didn't have the talent. They'd get to the 5-yard line and doing a direct investment and get cold feet and bail because they just didn't have the confidence to do it. And that, in fact, the venture funds and even the private equity funds had contributed real value because they were able to evaluate these investments much better than a family office that didn't have that skill. Today, there are more and more of them that are bringing analysts on board and willing to do the deep research, the deep due diligence, and technology has advanced such that a lot of the research and analysis of the direct investments can be done in the family offices, whereas most of the talent was somewhere else. So there's a there was a lot of talk about it, direct investments prior. Now there's a lot more direct investments. On the scale that we're talking about, meaning small scale, writing $500,000 checks and $2 million checks and $5 million checks, so that's happening more and more and more. And that just if you're a researcher, you might be interested in knowing that on a private equity side, there's family offices that won't deploy a check unless it's $100 million. So they were disintermediating the street, the investment bankers, because the investment bankers would get their 6% of the money raised and 6% warrant on the company, and they'd come to the family office and they'd say, okay, we want you to write, a $100 million check, or 50 or something less, or I know it sounds like a big number. And so what was happening is saying, okay, so that's going to cost me 6 and 6. Why don't I just do the deal myself? I'll do the whole thing. So again, investment bankers have their purpose and they have their value, but there's been a disintermediation and a compression, and a lot of direct deals are being done by the family offices because they now have the talent on staff to not make a mistake. That's really what they're worried about.
So do you have the talent on your staff, or you are the staff doing it?
I don't do anything. I hang out with Lisa.
And she does it all for you.
Yeah, no, Lisa, no, not at all. I mean, not that she couldn't. That's not. I didn't. That's not. She has better things to do than analyze my stuff, right? No, I have
my stuff.
Right, exactly. Yeah. No, I have habitually used the analyst bench of other family offices, which is how this community grew. So that worked out so well for me, and it saved me millions of dollars in overhead. Now I have staff that count things and keep track of stuff, and I don't know that I should disclose this, but I will anyway. I own 37 operating companies. They operate, and then I have people keeping track of that, so really talented staff. But most of the analyst stuff that I have done for me is done by other family offices, analyst bench that are specifically talented in that area. So I've continued to do how this all started.
We've got a question from our online audience.
Okay, great.
Janet Harrison asks, are there family offices that target certain industries or even women founders?
So there's few things you can generalize and say about family offices, but one you are pretty safe to say is that they tend in the first generation to invest in the types of companies that caused the wealth. So if they made their money in real estate, or if they made their money in furniture, or if they made their money in the operating company that they made their money in, the type of business, they generally tend to invest in those types of things. When it moves to the second or third generation, it's less so because they're sitting on a pile of cash. It's not always the case, and they tend to want to diversify their risk. I don't know any specific family office that has made a commitment to invest specifically in women-owned business, but there is a trend to, there are more family offices that are controlled by women because they were part of the family, and there is definitely a sentiment to be mindful of the imbalance of funded women entrepreneurs. So I can't think of one specifically, but they're there. I think we have a question over here.
Would you?
That's great. Thank you. This is interesting. I was hoping you could speak more about the operations of the community and the platform that you mentioned that interweaves many families, and in particular, the issue that I'm thinking about is that many times entrepreneurs are not eager to see their decks spread far and wide among too many families all at once, or too many potential investors. And the flip side of that, of course, is that as an investor, you're not enthusiastic about looking at an opportunity when you know that a few dozen other really smart families have passed on it. I'm hoping you could speak to that.
Yeah, so you identified the essence of the deal flow problem. There's way too many opportunities to look at, the fire hose idea. And if, again, this is an emotional thing, even though it's pragmatic, if a deal gets to somebody and it's been picked over, then it becomes burnt like a piece of art, meaning that somebody else has looked at this and said, no, why are you showing it to me? So to talk about the structure of the platform, we haven't solved all this problem. We're trying to solve it. We have our good days and bad days and the way we do things. And just to be clear, Family Office Insights is the name of the platform, and we are totally cool and we do a good job, but boy, we are not a study in efficiency. So imagine 200 companies that come in a month that we look at, and those companies are largely coming from the 800 family offices that are part of the community. So the deal flow is pretty good. I mean, it's got a good filter. And so on the one hand, we've satiated the community by getting deal flow that comes from their peers. And so the process of selecting which ones end up being submitted for qualification and then brought to the other families to see if they're interested is not secret. It's just a matter of which ones we think will be more interesting to others. And then, so we don't blast it out to everybody. There is an opportunity that once you get selected and qualify, you can socialize your opportunity before or after it's funded, and that's your choice. But the other part of it, which you well identified, is that counterintuitively, the family offices want deal flow that hasn't been picked over, and they have a huge appetite for it. And if it's come along and it looks like it's something that's been passed on many times, it does get dismissed. So you're right. Having said that, we do a pretty good job of not causing those two bad things to happen, but it's not perfect. We do 2 or 3 luncheons a week, private luncheons where we have 15 or 30 family offices, and one company comes and pitches that was selected to do so in each one of those luncheons. So it sounds like a lot, but it's just one company per lunch. And so the process of us selecting those is not top secret, but it's largely the ones we think that the community would be most interested in, and most of them come from the 800 family offices that are in the community. So it's kind of top secret on some level. On the other level, the people who are part of the community see everything. Does that answer?
So I actually have 2 questions. One, do you invest in companies overseas, or is it mostly in the US? And second is about impact investing. So I know that family offices are active with impact investing, so I was wondering if you look at those projects differently, and if you have a specific cause that you're interested in and you're working on right now.
So personally, I'm focused on scalable human need, food, water, infrastructure, alternative energy. That's my focus right now for my capital. So that's my version of impact. There is the community and investors in general are keen on impact and understanding what that means, but there's multiple definitions, and everybody's hoping to get to a spot where you can have impact and not give up return on investment. And I think we're getting there. There's a really good trend going on where you actually can deliver meaningful and measurable impact on the environment and otherwise, and still make a good return on your investment, whereas before it was largely dismissed as something you had to give up 200 basis points that you would normally give. On the foreign investment, I'm just super chicken, and for me, I don't want to go anywhere that doesn't have governance that looks like it works. I just don't need to. The community itself has appetites in various parts of the world. Now, having said that, I'm personally invested in a coconut plantation in Fortaleza, Brazil that I own, but that was because I was drunk and bought 1,000 hectares. But I try to stay away from other parts of the world, especially with, you know, rule of law issues. Let's just say that. But there's a lot of interesting people in the community that have specific. They've made their money in other parts of the world and continue to invest in them.
So the key is to get Arthur drunk to unlock family office capital.
Sorry. Oh, what are some of the ways that you would recommend an entrepreneur just starting out to meet and network with folks at various family offices? It sounds like Family Office Insights, that's one great way that you're involved with. I wanted to see if there are any other recommendations you would give.
Yeah, there's dozens of good, and I know most of them, at least locally. There's dozens and dozens of good family office conferences. There's organizations you can become part of. I don't know, there's probably 6 or 7 I know of that do good conferences. So I regularly say we're not clearly the only way to do it. There's a number of ways you can buy family office databases, and you know, a list is kind of worthless, but it's you know, one way to connect with people. Do the normal networking thing, go to do events and ask people about family offices. The wealth management platforms, your wealth management friends in the big banks know a lot of family offices. They can't, from a regulatory perspective, bring clients to you to invest in your startup because it has to be overseen by their broker-dealer. But they can introduce you to family offices and not go to jail for that sort of thing. They have to be super careful about suggesting that your investment's a good one, because that is a outside business activity and a cause for censure or whatever the proper term is. So, I mean, if you just Google family office groups, there's dozens and dozens and dozens of them, and they're all, I know most of them, and they're all pretty good. I mean, there's not any really bad ones, and some of the people who founded them are good guys and girls. Yes.
We'll also share something at the end of this that Arthur and I have partnered on to help you get more access to that. I think we have time for a couple more questions. So if there's any questions online or here.
You mentioned that databases can be pretty worthless, and I agree, like response rates are not good when you do cold outreach. Do you have any suggestions for how to get more of an impact from cold outreach? I think specifically because, like, you know, the conferences can be quite expensive. Databases are thousands a year, like the fundraising platforms, things like that.
I'm not suggesting you lie, but one of the counterintuitive things is starting the clock ticking before you need it. So I'll give you an example. There were private equity funds that came to us and said, we want to present. So we charge ridiculous amounts of money for people to present to keep tire kickers away. And so they would say, okay, we just closed our fund, and in 2 years when we open up our second fund, we'll come and pay your fee and present. I'm just giving you an example. And I said, bad idea. And they go, why? We're not open. We can't take anybody's money now, even if we asked. And I said, this is the best time. So if you sit and present, and you plant the seed with 30 family offices, when you're open, they'll be ready, because they're not going to give you any money on the first date anyway. So what I would say to you is, in anticipation to when you need round A, the email that you send to them is, I don't need money today and I want a meeting. When I'm in my round A, I want to let you know that I'd like to call you, and just drip campaign them. instead of saying, I want to talk to you right now. I know it's hard to resist the temptation, but you might be surprised on the result, because that is better than saying, I need to talk to you right now because I need funding right now. So you might need funding right now, so that might not work. That's why I'm saying I don't want you to lie. But doing that sort of counterintuitive thing and saying, look, I just wanted to let you know we're around. When we're doing our round A, we'd like to know we could reach out with you. And then the best way to connect with them is find somebody you know who either knows a family office or you know one, and get them to refer you in. I mean, this is common sense, but that's the most accelerated way to at least get to a meeting where you're going to have an audience.
Thank you.
From our Facebook Live audience.
What is this Facebook you speak of?
The internet asks. Dan Sider asks, what do you recommend to help others decrease their unconscious biases?
I think you should answer that. I think you should answer that.
What we can do to help others decrease their unconscious bias?
That's right.
Well, I think the first thing is to actually be aware that unconscious bias is happening, because no one is immune to that sort of bias. I think one of the main reasons why we see the way capital is being distributed right now is that people like to invest in people that remind them of themselves. And given the venture landscape is 94% male, that is reflected in the 2.2% capital that's being allocated to women. So I think, I mean, at the end of the day, it's awareness, right? It's the ability to ask the question, what do I not know? And I don't think enough people actually ask that question of themselves. Most people walk around assuming that they do know and not taking the time to question their own biases and what they believe about the reality in front of them.
Did you get the sense that that question was mostly around gender bias? I'm just wondering. You don't have to answer that. I think we have lots of biases, right? And you know, being mindful of as Lisa said, just being aware that they might exist is a very, very good start. I profile all the time. Do you have that on tape?
Everything is on tape. Great. Does anyone want to ask one last question while we have Arthur here?
We have two questions, one over here. You mentioned earlier that every family office has a specific allocation for venture investments.
I don't think I said every. I said
Okay.
most.
Oh, okay. In general. Is there a way to look up that information?
No.
It's so they don't like publish like their goals or their investment policy, like missions or anything on their websites? Or?
No. I mean, there are some stats and data points in PitchBook. Mm-hmm. You know PitchBook? Mm-hmm. Yeah. So the problem with PitchBook is I'm there, but you don't know who I am. Meaning it has a name of a company, it's a holding company, there's nothing to do, you wouldn't be able to identify. You might be able to weave your way eventually to me, for example. But PitchBook is anecdotal or empirical data post-investment. So it has some information, but it's one way to sort of go backwards. If you see one entity investing in a lot of venture, you don't know how much the overall assets are, but you might want to. I mean, it's a good backwards way to go.
When you said earlier that you would kind of look at something that you think the community might be interested in, the word interested, did you mean from a financial investment perspective?
Yeah. So we're talking about two different things, right? So just to be clear, when I said earlier this is not a study in efficiency, the way we look at the qualifiers for the community, you might give us more credit than is due on how we do diligence on those, because we're not endorsing those and we're not suggesting that they warrant investment. We're just trying to democratize access to things for the community that we think that they would be interested in, and have some entrepreneurs come in and pitch. And it's just a fraction, because there's only so many Tuesdays, Wednesdays, and Thursdays. I mean, it is a tiny amount of exposure. And we're trying to fix that through a variety of ways that we'll talk about in a minute. But there's the direct answer is that we just hold it up to the light and say, this one looks better than that one. So it's not very promising. It works, and the lucky few that get to present end up getting proper exposure, and the outcomes are good. But it's such a fraction of so many good entrepreneurs that are being unfunded.
Thank you.
Yeah.
Great. Thank you, everyone, for your questions. To round it off, I want to share an exciting partnership that Arthur and I have done together to bring you the Family Office Funding Challenge. So, Arthur, can you tell us a little bit more about that?
So this is when I was saying earlier, we've only can bring a fraction of entrepreneurs to the community. So for years we were getting 200 a month, 250 really cool companies coming from the family offices, and then some from a variety of other places. And then there's endless amounts of other platforms that have entrepreneurs that come in and, for example, apply for incubators and accelerators and that sort of thing. And so all these companies that we had to say no to that didn't qualify for a lunch, and some of it was altruistic, some of it was lifestyle, meaning that we had so much deal flow to look at, it was just a burden. So what we decided to do is essentially make a challenge. I'm not going to say it was like the X Prize, but sort of like the X Prize, right? And say, look, if you come in and apply, and you can actually win a Family Office Insights lunch and a NASDAQ studio Times Square interview that we do for the winners, and then Lisa has included one of her learning programs as part of it. So the idea is we don't have to use up, even though the award for this is a lunch, we can do video casts, we can do video challenges, we can do all kinds of things in the evening, we can do stuff on podcasts, so we can democratize access and satiate the two things, one of which you said here, the family offices have a huge appetite. And so what we're doing together with a couple of the partners of mine, one of them's in the room back there, Simeon, sitting on the couch, is we've created the Family Office Funding Challenge. And so to suck up that capacity and democratize access to the family office community, which is getting larger and larger, every week it gets bigger. People bring their richest, smartest friends to the luncheons. That we're basically giving away access. You have to apply, you have to qualify, just like anybody would apply for an incubator or an accelerator or something like that. We have cohorts once a month. We pick one or two people that win. They get a free Family Office Insights lunch and interview. And then we're going to be adding other ways to get people from around the world so we can do online interviews. So Lisa has brought her community in, and so we're coordinating getting access to and democratizing access to the family offices through the Family Office Funding Challenge. And it is exactly what it sounds like. You have to compete against others, and hopefully you'll be the winner. And then there's going to be some other things that we add to it over time. This is a work in progress. So that's part of what we're trying to do to, it's totally selfish. We have good deal flow for the family offices that have the appetite for it, and then we're going to get the opportunity to invest potentially in good entrepreneurs.
Can anyone apply, or do you have to be in New York?
We don't take New Yorkers, I don't think. No, totally open to everybody. Obviously, if you're halfway around the world, you may not want to come to New York to pitch, but maybe you would. So there are going to be some other things we make available for people who aren't make it easy for them, in that they can't come to New York, for example. So anybody can apply. So you're all welcome.
So in summary, it's currently how much to apply to a luncheon, and then what kind of investment do they get?
So the normal process is that if you qualify for a luncheon, it's $15,000, and we put 15 or 30 families in the room. So we're giving that luncheon away, plus we're giving a $10,000 interview at the NASDAQ studio, which you get a sizzle reel for all that. So that in order to qualify to get into the challenge, you have to submit an application, which our friends at F6S, I hope you're watching. They've done a really amazing job. They have a platform where entrepreneurs come and apply for incubators, accelerators. So we have the challenge on, it's F6S, the Family Office Funding Challenge. You can get through it, where you're going to get the link in a minute from Lisa. But I just wanted to give them props because they've done a great job for us. So you just apply, put your profile on there, and then if you win, you get the ridiculously valuable Family Office Insights Luncheon and get to meet a bunch of family offices that come to meet you with intent. They're able to invest, and they come because they know exactly why they're coming, which is the nature of the lunch. And then if you don't win and you're a runner-up, what are we calling them? Honoree. Then you get published in the Family Office Insights publication, gets sent out to 20,000 investors. So it's sort of it's awareness and access and something that you just can't buy.
An honor for the honoree.
Mm-hmm.
So if you are interested in accessing that, what we're doing tonight for the next week, so if you are here, you're tuning in, if you access it through actually going to Instagram right now, there's a link available on my Instagram story at Lisa Wang, and you'll find the Family Office, the FAM Office Funding Challenge. And if you swipe up, you'll be able to get access to that link. And with that link, you'll be able to get Arthur's white paper on the 7 principles for attracting family office investors.
Super valuable.
As well as our investor pitch masterclass that will be sent to you after you apply.
I love that everybody's on their phone. That's so cool.
My Instagram is Lisa Wang, LISAWANG, Lisa Wang, 2 times. So without any other questions, let's give a huge round of applause to Arthur.
Thank you, Lisa. Thank you. That was awesome. Thank you.
Awesome. So now we'll have a little bit of time to mingle and try and get Arthur drunk ASAP.
Thank you.